Good day, everyone. Today is August 31st. It's the last day of August, and as many people here in the Midwest refer to as the last day of summer. So as you know, this is my first inaugural mid-year market and retirement planning update. Let me say that I'm not a professional videographer, so bear with me as I sort of fumble my way through this. Very simply, my goal is to provide you with some good information in a short period of time so that you all can get back to your busy lifestyles and carry on. So the goal here is to make this less than 15 minutes long. Again, very short, very brief, but also very good information that will relate to all of you within our client base. So first off, we're going to give just a quick brief market update. What's in the news? What should you be concerned with? And what should you not be concerned with? And then secondly, how does that affect our portfolios as a whole? And we're not just going to talk specifically about what's happening in the markets in the economy. We're also going to talk about some retirement planning information, some news, some updates, some changes out there, and how that impacts all of us as we prepare or live in retirement. For today's version, we're going to talk a little bit about some upcoming changes to Social Security, or maybe I should say lack of changes. And then we're also going to talk about medical insurance with how it relates to Medicare, but also private coverage as well too. So the first thing we're going to talk a little bit about is what's going on within the markets. So we'll talk about year-to-date returns. We'll talk about the health of the U.S. economy. We'll talk a little bit about oil and how that impacts us. Talk about a little bit about global markets, what's happening there, and then lastly with the infamous what's going to happen with interest rates. So if we look at year-to-date returns, now keep in mind this is coming off of about a week ago. If we were sitting here a week ago from today, most of us would have been in a little bit of a panic due to the large drop in the U.S. and global markets. We saw over 1,000-point correction in the Dow Jones just over the last week and a half. Now, what's interesting is if I were to tell you here a week later that most markets are actually up, I bet many of you would have not realized that, right? The media does a fantastic job of scaring the crap out of us, for lack of a better term. They're so short-term focused that it's really kind of disheartening sometimes to see this go on. But nonetheless, the markets are not really in bad shape, but we're really not progressing anywhere. So you can see year-to-date, the S&P 500, for example, which is the 500 largest companies within the United States, is it's down 2% year-to-date. So again, very minimal growth, or a lack of growth as I should say. But again, with all the bad news, with all the pictures that the media presents, we're really not in a terrible position overall. The one area that is sort of hurting is the emerging markets. You can see about year to date they're down 12.5%. So hopefully your emerging markets sort of turn the corner. Much of this is due to the recent decline in commodity prices, which we'll talk about. So the U.S. economy, I think the million-dollar question is, are we going to have a recession? Should we be worried? And in most people's cases, a recession equates to a 20% correction in the stock market. Well, first off, in order to have a recession, you need to see your major economic indicators start to decrease or go in the wrong direction, and that's not happening. Housing's up 4.9% year over year. New homes constructed, I should say, are increasing at a good rate. Manufacturing, PMI, which measures the health of the manufacturing sector, has gone up for 73 consecutive months. And unemployment continues to trickle down. We're currently at a 5.3% rate, which is very reasonable within historical terms. So if you look at just these three alone, you would see that we're nowhere near a recession with regards to these main indicators. Now, some of the worry is, well, geez, oil has went from $110 a barrel all the way down to 38 as of last week, and now I think we're back up into the low 40s. Is that anytime you see any sort of market correct this quickly, that becomes a big concern. And we'll talk a little bit about that. And then lastly, we'll talk about interest rates and how that impacts us. So let's talk about oil. So the first thing I want to say is that just because oil prices go down does not mean that gas necessarily will go down. Along the way, when oil is refined into gasoline, it needs to go through a refinery. And there are different pricing structures within that. So if oil goes down by 50%, you're not going to see gas go down by 50% necessarily. There's other factors that come into play. But let's just assume that for a second. The average consumer spends about $2,000 a year on gasoline. So if gas went down by 50%, the average person would spend about $1,000 or would save about $1,000 on gas, right? So even though that's a good savings for most people, it's not necessarily going to spark a huge amount of economic growth because it is such a small amount of money relative to consumers as a whole. Jobs. The oil sector or the energy sector as a whole is a great job market. And so with oil prices decreasing as they have been, that's going to put a huge buffer as far as creating new jobs, and in most cases it's going to retract jobs. I was recently up in Williston, North Dakota, which is really in the heart of the oil boom, and you're starting to see a little bit of a slowdown there. It's by no means quiet, but it's not as go, go, go as it was maybe 6 months or a year ago. So the other thing with jobs is that it creates very good jobs, and it also creates blue-collar jobs, which are harder and harder to come by in this country. Lastly, the one piece that you're not hearing about very much is debt within the energy sector. Back in 2007, it was only 7% of the overall high-yield debt, which is lower credit quality. Today, it's 17%. So you have a lot of companies that have taken on debt probably when oil prices were a lot higher, and their business models were created around profits at higher prices. So I think we could see some concerns within energy default or solvency maybe a year from now if prices continue to stay this low. Not a concern today. So if we go and look a little bit at the global economy, the one piece I want to talk about is maybe a very overhyped matter was Greece. Greece is only about 0.38% of the world GDP. The issue with Greece and what all the fuss was about was not Greece itself, frankly. If they're not here, that's not going to affect the rest of the world that much from an economic standpoint. The issue is that if the European unions were to agree to allow Greece to forgive some of that debt, essentially wipe it away with no repercussions, are they setting a precedent for other countries like Italy or Spain, where they both have very high debt levels, and would they start to ask for some of the similar deals as well too? So the issue here that lies, and this is more my opinion, is that when you have countries who politically govern themselves individually but all fall under the same monetary policy, for example, is that becomes very difficult because everyone sort of has their own agenda, and it makes it very difficult to control things long term. And I believe this is really what's sparked these just astronomical levels of debt within the European countries. And to be quite frank, until these sorts of government policies change, we're going to see stuff like this for a long period of time. And Greece's debt is nothing new to the world. This has been lingering out there for decades and decades. So again, not a huge impact to the economy. It's nothing new. Now, the one piece that is probably hot off the press, if you will, or is probably the biggest risk to the market is the Chinese economy. China's been the fastest growing and the largest growing economy for decades, is that they've grown at double-digit rates. And when you have a country as large as China growing like that, and then all of a sudden they slow down dramatically, so let's say growing from 10+% down to 7%, that can have a very large trickle-down effect to the global economy. If you look at the US, for example, is that 3M, I believe, has about 68 to 70% of their revenue come from outside the United States. Now, I don't know the exact amount of that is directly in China, but I would venture to guess is that it's a very large portion of that. So again, really the big key thing to look at is that if the Chinese economy continues to grow, or if it slows down further, that may be a good warning sign or the go-ahead sign as far as what we see is going to happen in the world markets going forward. Now, one other measure is that we've seen is that China devalued their currency. Well, let me explain why they do this. Is that the main reason a country devalues their currency is because it makes their exports less expensive. So it would be cheaper for us to buy their goods. In hindsight, though, it becomes more expensive for them to buy our goods. So in return, what they're hoping is that we buy more of goods in China, and then that the Chinese people in return buy more of their own goods versus importing goods itself. The real, I guess, tough spot we're in now is that the US wants to raise interest rates, which in return will strengthen our currency. And by doing that, that really goes in the exact opposite direction of what China is trying to do currently. So Janet Yellen came out last month and said that it's most likely that we will try to raise interest rates at some point this year. And what they're trying to do here is signal that we're going to move monetary policy in the US in the right direction. So what we're not going to see is a substantial rate increase. It's probably only going to be about 1/4%. But they want to show us, hey, we're moving in the right direction. We want to get away from all of the stimulus and hopefully get back to a little bit more of a normal economic period. But after saying that, now we've seen a lot of news, a lot of data come out with regards to China. And so it's not about whether the US economy can support a rate increases, can the global economy support it? And so we need to keep an eye on this. This is really going to be probably a hot topic that we're going to hear about almost weekly up through the end of the year. Now what's interesting is that the media does a great job of scaring us and saying, well, if we're going to raise rates, that's going to be bad for the markets. Well, if history is any sort of indication, that's completely false. As you can see over the last 6 rate increases, that 250 trading days before, which is basically a year, and a year after, is that the markets have done well in both of those scenarios. And if we go out 2 years after, we can see that it's done equally as well. So I would venture to believe that, is the rate hike really good? I would say bring it on. History shows that it could be a very good thing for us. So what we're going to do now here in the last couple minutes is shift gears. So this year marks the 80th anniversary of Social Security. I'm sure not all of you knew that. Again, kind of useless information. But what's more important is that the OASDI trustees, which really govern what's happening within Social Security, anticipate there will be no cost of living increase for 2016. Right? The few averages they look at are showing that most likely inflation, our Social Security will remain the same and there will be no inflation. Now what's important about this is that for those of you that are on Medicare or you're post 65 and collecting Social Security, is that most likely your Part B premium automatically comes from your Social Security check. That's about 70% of enrollees. Now, there is a clause within Social Security that says your net Social Security check cannot go down. And why I'm talking about this is that Part B premiums are anticipated to go up for 2016. As you'll see here in this side, you can see based on your income levels, they're actually anticipated to go up quite substantially. So if you're currently enrolled in Part B, I would make sure that is taken directly from your Social Security. If that is done, then you will be able to avoid the rate hikes for 2016 and keep current rates. So if there were any sort of inflation for last year, it would be eaten up by the fact of increased premiums in Medicare. Now, along with that, those that are pre-Medicare or pre-65 is that you have to go out and buy your own private medical insurance. With the changes to Affordable Care Act is that we've now are anticipated to see premiums increase from 20 to 40%. I'm not trying to be political, but when you add more people to the system, it usually makes things more expensive. It does not make it cheaper. Blue Cross of Minnesota anticipates premiums going up by 54% next year. This is astronomical. So again, these are very big roadblocks that face retirees and need to be planned for in detail. Lastly, just Fidelity came out with a study. All I'll say here is make sure that you're having good communication with your spouse. This study showed that 43% of couples can't answer how much their spouse makes, and 36% provided different estimates when asked about their investable assets, and 47% disagree of how much they'll need to save for retirement. So again, what I would say is number one, have a great week, but number two, hopefully you're having good communication with your spouse with regards to retirement planning and your finances.